Hey everyone, my name is Nick. I'm an accountant turned financial planner and now a buyer's agent. This video is all about how I would start from zero in 2024 to build a property portfolio, and I'll also share with you how I'm investing in property today. I bought my first property at 19 years of age, and fast forward now to 32 years old, I now have a $5 million portfolio. All right, so I want to first start off with my investment approach, and then we'll cover the essential steps for anyone who wants to go out and start buying property in 2024. Now, my personal plan is somewhat different because I've already gone through the process of buying stock standard properties, holding onto them, making a bit of money, but I'm now at a stage in my property portfolio where I really want to start generating value really quickly with a hands-on approach. I'm focusing specifically on the Sydney market as well as the Central Coast market. I'm currently doing a knockdown redevelopment of one home in the Central Coast into 3 townhouses. And once that project is completed in Q1 of 2025, I'll be able to go out, sell some of those assets and do a similar project all over again. So my property strategy is very much development focused because me and my wife have made the decision to generate as much equity as quickly as possible so that we can buy a home in Sydney for ourselves. Our goal is really to do as many development projects as we can over the next 3 to 5 years. We're targeting projects starting off with a $1.5 to $2 million purchase price, putting on a duplex or a townhouse development on it, selling them all, pulling out $1 million to $1.5 million worth of profit on each project and doing that all over again. Our plan is very much about building equity and building cash relatively quickly, and fast forward 5 years having a pool of about $5 million cash that we can use to buy a house in Sydney outright. If I was starting off today with zero, this is what I'd be doing. As a starting point, I want to get my foot in the market and buy property. If you have made the decision, and you probably have because you're watching this video, you're looking to use property as a vehicle and an asset class, generate an income stream, or generate a large pool of money. Many people think that you need to be looking at properties that cost $800, $900, $1 million to get started. But the reality is you can start to buy great assets for around that $250,000 to $300,000 mark. But there is a caveat that there will likely be a villa or a townhouse in a regional area. But at that price point, it means that you can get started with a $40,000 to $50,000 initial deposit. And yes, you do need to save for that amount, but it's not an unrealistic amount for a family or a couple to save. And if you do have that $40,000 to $50,000, that's sufficient to go towards a nominal deposit, pay all your buying costs, and still pick up a property in that $100,000 mark. But if you have the savings capacity to wait another 6 months or 12 months and get your deposit up to around $70,000, $80,000, or $90,000, that opens you up to way more properties in that $400,000, $500,000, potentially even $600,000 mark, depending on the rental yield of that underlying property. You're able to buy a freestanding house, typically 450, 500 square meters or more, and they come with really good family appeal. Next step is to focus on high cash flow properties. Cash flow is crucial on your journey to accumulate lots of properties so you can hold on to them for as long as possible, wait for them to appreciate in value, and sell down a portion of your properties to pay off your debts. Cash flow is king in that strategy. Now, what that typically means in 2024 is that you can't really be buying $500,000 to $600,000 properties in Melbourne or in Victoria, as an example. And that's because yields are relatively lower, starting at about 4 to 4.5%. Taxes are pretty expensive, or relatively expensive as an investor. Buying in Melbourne, buying in Victoria make it really hard as a first-time investor with a limited budget and buying your first property. So by default, you're forced to look at regional areas around the country, and even in places such as Perth, where you can get properties with a starting yield of 5.5 to 6, potentially even 7% yield. And again, it's a function of your willingness to take risk and go to areas that you may not have heard about before to buy properties that have really strong rental yields. And that leads me on to the third step, which is to think outside of buying in Sydney and Melbourne. You're from a capital city area, you're very confident and comfortable investing in the area that you live in or know well, but there's lots of areas around the country where people live, people work, there's industries, there's jobs, there's whole economies in regional hubs around the country where there's still an opportunity for you to buy great cash flow properties for $500,000. So I really encourage you to embrace that borderless mindset. You've got the data points that give you the comfort to invest without necessarily living or knowing that area implicitly. And that leads me onto the fourth, which is to rely on data to make really good decisions. Now, there's lots of data points to look out for in the market, and I'm not going to go through each one of these specifically, but what they all bubble up into is 3 things. And this is a framework that we use at Handle Properties, and that is population, income, and infrastructure. So all the areas that point to, ongoing capital growth, really tight rental markets, really tight supply, they bubble up into these 3 things. So that is population, where you're looking for data factors that point to ongoing population growth or really high demand now, as well as constrained supply in that area. And income, that is looking for areas where people who live in that area are making more money, and they're making money from diversified industries or businesses. So this immediately weeds out those high-risk areas, those high-risk mining towns where people are dependent on one industry or maybe even one employer for that town's income and that economy. Finally, we look at infrastructure. So obviously you want to look for areas where governments are spending big money on hospital, ports, train lines, and roadworks. That's always super important. But the other layer to infrastructure that is often overlooked is where private business is spending money, such as where is Bunnings going to be opening up their next location? Where is Officeworks looking to open up their next location? Where is Hungry Jack's opening up their next lease? For example, a Bunnings having lots of smart people doing their own analysis before they commit spending many millions of dollars to invest in a new area. So that's always a great index for you to understand whether private business is also interested in investing in a particular region. And when you've got all of these layers factored in, you've got a region that ticks the boxes for population growth, income growth, and strong infrastructure, and it's got really strong cash flow, it's very important that you also look for areas where you do not compromise on capital growth. Cash flow is how you accumulate lots of properties today, but capital growth is how you are able to exit some of these properties for a premium in the future to pay off all of the debts that you have accumulated along the way. Learn how to read the market and see where capital growth is likely to come, and make sure that you're shortlisting these areas. Finally, thinking about your longer term strategy, you want to be looking at areas where you can diversify your exposure to different industries and different markets. So you might go out and buy your first property in a regional town that ticks the boxes for high cash flow, really strong population growth, income growth, and infrastructure. But don't buy your second one there as well. You want to be diversifying and looking at regions across the country, because inevitably, as some markets do really well, some markets won't do as well. And once you have an overall portfolio view of your property assets, you want exposure to different markets that will perform over the long term at different times. By diversifying, you're hedging your risk, but you're maximizing the potential at different times. Let's recap. If you're looking to start buying a property in 2024 from zero, start with at least $70,000. You can get that property for around $500K. But don't worry, if you've only got about 40 to 50K, you can still get in for a property around $300,000. Focus on cash flow positive properties. Think outside your hometown. Be confident investing interstate, and make that decision based on really good data points. In this entire process, do not compromise on capital growth, and be open to diversify your portfolio by having exposures to different markets. And whether you're looking to do this solo or you're looking for a helping hand, we at Handle Properties are here to guide you through the process. Check out our website and Handle Properties. We are buyers, agents, and property advisors. We take care of the entire process end to end. Our clients are typically those that have very busy jobs, are very time poor, and just need someone to execute and get them on the property ladder and start building wealth quickly. Thanks again for watching. Go out there and start building that property portfolio.